Ladies and gentlemen, good day and welcome to the Tech Mahindra Limited conference call to discuss the acquisition of CTC. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vivek Agarwal, President of BFSI, HLS and Corporate Development. Thank you, and over to you, sir.
Thank you, Fazan. Good evening, everybody, and appreciate joining this call on short notice. And I hope all of you have had a chance to look at the investor deck, which should be available on our website, and Kaustubh has kindly arranged to send to all of you. I'm going to take a few minutes upfront to talk through some of the salient points in the deck, and then we'll open it up for questions. Just from a transaction perspective, this is three primary strategies and rationale of why we've done this investment. Firstly, we believe that the insurance industry is going through significant transformation, a lot of new emerging business models, and a lot of it is being disrupted by technology. So this is about us doubling down with increased focus on scaling our insurance business over the coming years. Secondly, CTC brings in deep digital technology skills and capabilities. They've been involved in a number of marquee digital transformation work with their client base, and we think it's a very scalable capability, not only for servicing their existing client base, but also being able to cross-sell and take to a bunch of Tech Mahindra clients globally. And lastly, the business services clients in Europe and in the US, but the delivery centers for the company are based in Latvia and Belarus. Those countries and the region provides excellent technology capability and talent. And as part of our plans, we do think this is a very scalable talent base with very high quality talent availability, which we would expect to grow many folds in the coming years. So that's the broad thinking around these investments. And just getting into some of the detail. So as you may have seen from the communication, this is a couple of transactions together, and the reason they are combined is they are owned by the same shareholder group, and they're all very deeply focused on the insurance industry and financial services industry. The first is a core 100% acquisition of CTC, which is 100% services business. And we are acquiring that business for a total consideration of 310 million euros. Out of this 310 million euros, we will pay 210 million upfront, and the balance 100 million is linked to the performance of the business over the next 4 years in the form of earnouts, as well as synergy-linked payouts. And I think this is just to ensure that we drive the right levels of synergy and cross-sell as we move forward in integrating this business with Tech Mahindra. The second part of the transaction is a minority investment into two insurtech platforms. The two platforms have a proven technology stack, have a proven business model. They have active clients on the platform, and they go to market in a SaaS business model, and helps customers address very specific needs in their business. We do believe that these are very scalable platforms, and with our participation, we would have the ability to take these wider into the global market, as well as provide scalability to these platforms over the coming years. We're taking a 25% equity stake upfront in these platforms, with an option to subsequently increase our stake at a predetermined valuation within the next 2 years, if we may wish to do so at our choosing. Just a quick snapshot of the businesses. CT Core, which is the core services business, did about 71 million euros in revenue for the full year calendar 2020. And for the first 9 months of 2021, the business turned over about 59 million euros in revenue, 720 employees, and the business has seen significant growth rates over the last 3 years, a 40% CAGR on revenue. And on a consolidated basis, this business would deliver industry-leading EBIT margins to Tech Mahindra. The two insurance tech platforms which we're looking at, the first one is Swift, which essentially focuses on sales and distribution, helps set up digital broking capability, price comparison websites, and helps insurers launch new products, go to market very quickly with an out-of-the-box solution. Currently runs has a bunch of clients in Europe, but we do believe both added functionality as well as added go-to-market strengths will offer a significant upside to both the market we can address as well as the functionality we can offer clients. And the second insurtech platform we've invested in is Surance. This is a very unique technology and platform which was developed in Israel and helps insurers underwrite personal cyber insurance. And it helps collect information, data, helps with managing the risks for the insurer. So these are both B2B platforms which help insurers or brokers develop and take new products to market. And these platforms will provide the technology backbone for those products. So on Surance, there are a number of leading global reinsurers who use the platform to underwrite cyber insurance. But we also see this as part of a bigger market which is focused on data-driven insurance underwriting, and we see a big market opportunity out there. Just quickly, and I touched upon this in the opening statement around the strategic rationale, but this is about high-quality digital engineering, a scalable talent pool and workforce in Europe, and very, very deep domain expertise in insurance and reinsurance industry. And lastly, I'm going to touch upon how do we see value creation from this investment. I briefly said that the business has industry-leading margins and will be accretive to the Tech M EBIT margins. And also the transaction will be accretive across a bunch of financial parameters around EPS, free cash flow, and ROCE. We will rebrand, co-brand the business as Tech Mahindra CTC from day one, and this will become part of our overall operations. And we do have an integrated management team structure which has been set up and agreed with the management team and sellers of the business who will be responsible for the business going forward. And they would also be focused on driving synergies, which are largely around cross-sell and scale-up of digital engineering capabilities, as well as the ability to sell the Tech M service lines in the client base, which comes in with the CTC acquisition. This is extremely important for us, and that's the reason why when we set up earnouts, it's not only earnouts on standalone performance of the business, but earnouts include earnouts also include payments linked to achieving the synergy goals for the combined business. And lastly, on the global insurance scale-up, I think on the back of this transaction and these investments, we are very focused on creating a dedicated go-to-market for our insurance business. We think that the market is very attractive in the segment. If you look at spend data, the insurance industry spend on transformation and new business models is at least 2 to 3 percentage points more than the overall industry, and we see this as a great opportunity to play a disruptor in this industry. So we are geared up internally with the right alignment of management team personnel to go after that opportunity. Apart from growing the whole digital engineering practice on the back of these investments. I'll take a pause here and open it up for questions. And as the questions come in, happy to address as much as we can. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The first question is from the line of Mukul Garg from Motilal Oswal Financial Services. Please go ahead.
Hi, thank you. Thanks, Vivek. I think very interesting acquisition. Just a couple of clarifications, if I may. First, if you look at the two InsurTech platform, can you help us how old are the companies and what is their current revenue run rate?
So, Mukul, the two companies are between 1.5 and 3 years old. Okay. I can give you the number of clients and where they are in their evolution rather than revenue numbers, and the business model, if that helps understand a little bit more. So Swift Online works with insurers, brokers, and currently has 2 live clients in Europe, and they get a percentage of the brokerage fee, which is generated on the platform. That's the business model they go out to, and there is an installed base. There is revenue long-term SaaS contracts with digital brokers and online platforms which use this technology to power their customer journeys and the sales and distribution process. On insurance, the model is slightly different. The platform works with insurance carriers as well as reinsurers to help assess, manage, and then underwrite personal cybersecurity risk. This is on the basis of the technology and the IP the company carries. They look at understanding the risks involved and then managing it, which is obviously of great value. Any of that data is of great value to the insurance companies, and that's what this platform provides.
Sure. And just wanted to kind of touch upon the motivation for this transaction from the seller side. If you look at this particular acquisition, the valuation looks quite attractive for you guys, given that they are into digital engineering and product development space, both of which are quite hot. But the valuation seems still fairly attractive. So, after working for about 20 years in the space, what was the motivation for the seller to exit fully, at this valuation? The obviously reason looks like that it was for the tech platform, but again, they are giving you almost a 45% type of a stake over a few years if things go well. So if you can just touch upon what was the factor which led them to do this transaction at these prices?
So I think, Mukul, firstly, a great bunch of entrepreneurs who built this business over the last few years. And a lot of the growth has been in the last 3 or 4 years. As I said, last 3 years CAGR is about 40% from a revenue perspective. What I would like to say is that this has been a bilateral deal. We've built a great relationship with the founders over a period of time. They buy into a larger vision of where this business and this entire capability can be as part of a larger organization. That's the reason why some of the earnouts and payouts are linked to synergy achievement, because they do believe in the wider vision of what we have for the businesses. And I think the second reason is that, while the services business has its own momentum, the structure we have adopted will also help fund the next phase of growth of the two insurtech platforms, while the founders and the management, can focus on building more functionality, taking it to market on a wider basis. And we would love to take them to market to our client base, to different parts of the world, and provide them with a global reach. So I think it's a holistic vision of what we think we can jointly build together. It's been the big driver for this.
Thank you. Just one clarification. What's the current attrition rate of the company, if you can share?
They are a single-digit attrition rate, so very well run, very tightly and well managed business, and if I may say so, a little bit under the radar is how they've operated to get to this great success.
Thank you, and congratulations. I think it's a good acquisition from your side.
Thank you.
Thank you. The next question is from the line of Ankur Rudra from JP Morgan. Please go ahead.
Thank you. Hi, Vivek. Hope you're well. So, congrats. Looks like an interesting deal. Could you specify this 40% that you mentioned in the entirely organic in the last 2 years?
Ankur, that's correct. It is all organic growth over the last few years. Absolutely.
It looks like it struggled to grow. I mean, it was a bit more of a slower grower for a long time, and it's only picked up pace in the last, like you mentioned, last 2 or 3 years. Any changes in the ownership or structure of focus which has driven this?
The short answer to those questions is no. It's been the same set of founders. I think what's happened over the last few years is they've built a great knowledge of their clients' understanding of deep business processes and understanding of the core of their clients. And as customers have undertaken large-scale digital transformation, they've looked for people who understand their core business rather than trying to get horizontal skills and then helping people understand their business processes, etc. And what they found in CDC is a ready understanding of the core of their business as well as some top-notch technology talent. And I think that combination is what's driven growth for them over the last few years.
Okay. And could you clarify how widely spread are the earnouts, for the founder team and the senior management team of the firm? And what is the duration?
So the duration is 4 years, including the calendar year we just finished. So there's 3 full years on this after this, yeah.
Okay.
But it was in 4 parts, yeah.
Okay. And beyond the founder, is there any layer of management in the senior management who is also participating in the?
Sorry to interrupt you, Mr. Rudra. The audio is not clear from your line, sir. Please use the handset mode.
Sorry, I was saying that. Do you think the extent of lock-in is beyond just the founder? Can you elaborate if it's in the senior management team as well?
So there are a bunch of key personnel who do not have significant equity stakes, but we put them as part of the transaction on a retention plan for 4 years.
Okay, understood. This last question from my side. You've had an interesting, quite a successful strategy in the last few years, which is, as you highlighted in a recent analyst day, a programmatic method of going on M&A. Bigger transaction in comparison to what you've done in recent years. Is this a slight change in approach, or are you just a bit more confident in terms of the targets you're going after?
Ankur, I think, and you refer to the analyst day presentations where we did put out a strategy and how we're executing on it. And I do believe we are executing fairly well on our strategy of how we integrate, how we go after large deals on the back of acquisition. So yes, absolutely, there is more confidence. I think from a size perspective, as you would see from a revenue size perspective, this is very much in the sweet spot. We've always articulated this is about $100 million in revenue or $90-something million in revenue on an annualized basis. I think from a valuation perspective, it is reflective of what we believe is the quality of the talent, the overall capability set, and as I said, industry-leading EBIT margins. Yeah.
Okay, I understand. Thank you, and best of luck.
Thank you.
Thank you. The next question is from the line of Kawaljeet Saluja from Kotak. Please go ahead.
Hey. Sorry about that. Hey, hi. Hi, Vivek. My question on the acquisition is twofold. One is that can you talk about your own insurance capabilities, which you can cross-sell which can cross-sell and make the best use of the acquisition. When I look at your own financial services practice size, including banking, that's about $1 billion, which is modest. So can you just detail the areas of synergies out?
So, sorry, Kawaljeet, you said twofold. So is there a second part of the question, or you want me to go ahead with the first part?
Okay, I'll go ahead. Now, the two, the acquisition, the investment that you have made in SAS, right? Was the investment co-terminus with the overall acquisition, or you had a choice of not making that investment?
The second one is an easy one, so I'll take it upfront. It was our choice, and as I responded to Mukul in the first question, we do believe that the combined vision for the industry and how we would work this together with the founders was critical, but it was at our choice.
Yeah. So why restrict yourself to just 25% investment? Why not go the whole hog?
So I think, Kamalji, the structure is that we have invested 25% and we have an option to buy another 20 again at our choosing. We've just used a staggered approach, and we do think if we do exercise our option, it would give us a pretty significant stake as these develop to the next stage. And to your first part of your question around, what is our capability set in BFSI and especially in insurance, and how do I see synergies working? As you rightly said, BFSI for us is now about $1 billion business. But if you look back on this has been a high teens growth over the last 5 years. We are somewhere in the 17-18% CAGR in BFSI over the last 5 years. And I think the way that business has been built over the last few years is around identifying specific trends and creating a right to win following those trends. Because if you look at 5 years back, we were a 300 million business unit in BFSI, and there was no differentiation. But I think, so from a strategy and logic perspective, we are following the same, that if we are going to create differentiation and a right to win, it gives us a better chance to be successful in the market. It gives us, it does give us scalability. And when I look at where do we see synergies, I think there are two ways to look at this. This business largely works on helping insurers and financial institutions do digital engineering, digital transformation projects on the development side. So they essentially are an enterprise OPD shop where they build next generation digital products for their clients. So that capability and that skill set is very fungible to our clients. So that could be one part of the synergy. And I think the second part of the synergy is going to be on our client base. On their client base, where we do believe we should be able to sell horizontal service lines, scale service lines, which today this business does not deliver. So they actually leave enough money on the table for some of the other players to come in and fulfill those capability sets. So it's a combination of the two. And then as we look at combining those sets of capabilities, we also believe that it will improve our chances of winning in the market for new clients, etc.
Got that. Just no, that's very helpful perspective, Vivek. Just a question for Rohit or Milind. I don't know whether this question was asked or not, but is this what's the amortization charge from this acquisition, and will this transaction be EPS dilutive or accretive?
So, Rohit, you want to answer, or I can answer the part of the amortization charge?
Yeah, go ahead. Go ahead.
We've obviously the accountants will ultimately finally opine on the quantum, but right now we assume a third of the transaction value will get amortized over 8 years, linked to client contracts and client relationships.
I mean, but would there be amortization related to marketing intangibles, brand name, or client contracts is the only thing amortized?
The client relationships and those are the ones which will get amortized. Yeah. And our estimate is a third of the value will get attributed to that amortization.
So, Kamalji, that is actually a group which will include customer contract and customer relationship.
Okay. So your approximate charge will be around 13-14 million euros. Okay. And whether it's EPS accretive or not?
Yes, it is. Yeah.
And on a GAAP basis?
That is correct. Yes.
Okay. Thank you so much. Yeah, and also.
Thank you.
Thank you. The next question is from the line of Nitin Padmanabhan from Investec. Please go ahead.
Yeah. Hi. Good evening, everyone. Congrats on the transaction, Vivek. I think you mentioned that the annualized revenue was around 90 million euros. Now, is that correct? And that would actually mean that the fourth quarter is like 31 million euros.
No.
Is there so much seasonality in the business? How should we sort of understand it actually?
No. So, Nitin, sorry. I did say $90 million because the question was on size. So it wasn't 90 million euros. Okay. So, and the business has no significant seasonality. Yeah. So the numbers will be, I'm not at the liberty to make a forward-looking statement of where the December quarter will close, so hence we've given you 9 months revenue, but there's no seasonality. And again, just for good order, the 90 million was US dollars and not euros. Yeah.
Understood. So if you look at the past 3 years, actually the growth has sort of been decelerating. It's like almost 10% growth this year on an annualized basis, right? A rough cut. So what's happening within the business that's leading to this deceleration? And going forward, do you believe that it can get back to earlier growth rates?
So I think, listen, as the business has grown, and one of the reasons why this is attractive for us is because we think we can help add value to bring scalability in the business. Yeah. The business has become constrained in its private ownership for various reasons. And one of the opportunities for us here is being able to build more scalability, more robustness into the systems processes for the business as we move forward. The opportunity is humongous. Obviously, I can't give you a forward guidance on what we expect here from a numbers perspective, but directionally, if we fire on all levers around building scalability on the talent side, there is enough revenue opportunity in the sector, both from a horizontal skill set perspective as well as an industry perspective.
Understood. So what you're essentially saying is the lower growth rate is because of underlying business constraints, which as a group together with TechM, you should be able to harness synergies and sort of improve, and that's what you're targeting, and that's why the earn-out. So and that's why the valuations are where it is how I would understand it. That's a fair assessment, right?
That is correct, Nitin.
Right. And just one last thing from my end is, if you look at this business in terms of the customers and the spread of the business, any sense on the geographic spread of business? That's one. And second, on the InsurTech entities, what are the are we in a position to sort of disclose what the ARRs are? And finally, I think this year we have had quite a number of acquisitions and very reasonable sum invested in an acquisition. Just wanted your thoughts on how do you think about acquisitions going forward? You think we'll slow down a bit, consolidate these and then move forward, or how should we broadly think about it?
So Nitin, last question I'll pass to Rohit to respond. On the two platforms, we are not, as I explained right at the beginning on the business model and the customer base, we are not giving out revenue numbers, but suffice to say these are early stage ARR numbers, and the businesses are scaling up. They've signed clients, but the full volume and the throughput on some of those contracts is still ramping up. And sorry, I missed your first question, if you don't mind, or if Rohit, Kaustav, you remember.
Yeah, it was on the geographic spread of the business.
Yeah, the geographic spread. So
yeah, and it overlays on TechM spread currently. Yeah.
Yeah. So the clients of this business are largely Europe-centric firms. They do have a couple of American clients, which are US headquartered insurance firms.
Yeah, and Rohit, can you hear me?
Yes, Rohit.
Yeah, we can hear you. Thanks.
Yeah, on the acquisition, it's also the way we look at it is the function of, as we've articulated in our investor day also, we evaluate our capability gaps, where we are organically on that versus availability of assets which the team constantly works on. So it's a function of all of that that we look from a acquisition perspective. So we'll continue to do that, and as we've mentioned, we've also changed the strategy to look at it in a more systemic basis that we mentioned. So hence, that's the approach change. But it's all a function of availability of asset versus the gaps we have, and I think given the timing wise, they've been, as you mentioned, a few that has happened consecutively, and as we move forward, I think we'll continue to evaluate those niche skill gaps with the asset and move forward on that. But overarching of all of this is continued focus on our execution that we've changed over a period of time, and we're confident on doing better given the approach we're following now.
Okay, that's helpful. Thank you and all the very best.
Thank you.
Thank you. The next question is from the line of Sandeep Shah from Equirus Securities. Please go ahead.
Yeah, thanks for the opportunity. Just wanted to understand these two insurance tech platforms. Are they getting any revenues from CTC? Because if I'm not wrong, both the companies are under the same founder company as a whole.
No, Sanjay, no, they don't get revenues out of CTC. Their clients are all third-party clients, insurers and brokers. So these are market-facing platforms. Yeah.
Okay. And whether the vice versa is also true, where CTC getting any revenue, because CTC being outsourced product development company. So is it CTC getting any revenues from these two platform companies?
There is a small portion of development work for one of the platforms which is done in CTC. That is correct. It's not very significant, but there is some work outsourced, subcontracted from a development perspective to CTC.
Okay. And just Vic, further to what Nitin has asked, CTC being a company which industry-leading margin, making FCF, high ROIC. So what are the business constraints which is not helping them to scale up, especially in CY21? Just wanted to understand if you talk the same.
So I think largely two things. One is sales. I think the company has very limited or next to zero sales capability. And as I said earlier in a different context, they haven't really gone out to market with the capability set they sit on. So that to me is constraint number one, that they've been very happy with their existing relationships, and the clients value their capability set. And secondly, in this industry, like everybody else, they've is the talent side of the equation. And on both of them, we do expect additional investments into sales. We do expect to use our market reach from a synergy perspective as well as from an organic growth perspective. And on the talent side of the equation, we do intend to bring in our systems, practices, processes to help scale faster. And obviously, any investments in the short term we need to make to do all of that, which in a private ownership scenario may have been difficult here.
Okay. And just a last on a strategic direction. So I think people are investing into engineering design and OPD more on the manufacturing, smart manufacturing, IoT, auto electronics. So given this is a sizable acquisition, how are we thinking to put these kind of a large sum treasury into capabilities of the insurance as a service industry to scale up? So are we believing that the scale up could be humongously high through this acquisition, especially for the insurance as a vertical for TechM as a whole?
So, there are three parts when you look at it, right? In this, when you say scale up, clearly one is insurance from an industry domain perspective, and a very unique set of very deep understanding of the industry processes, etc. I think we also think just from a scalability of the horizontal enterprise-focused OPD is a huge area. I mean, as large enterprises build digital businesses and digital applications, they all think and build stuff like a product company would in the old times. So that's a skill set which is fungible across industries. We do see that as a big high growth area for many years to come from as a horizontal service line, and then is scaling and diversifying our talent pool. This would give us a reasonable footprint to grow off in the region. And as you would all acknowledge, that region does give very high and deep technology capability skill sets. Hello? Am I still audible?
Yes, sir.
Yeah, can you hear me? Hello?
Yes. Okay. Yeah.
Yeah, this is the last question. For these two platforms, we are nearly investing 20 million euros for a 25% stake. So we are ascribing roughly 80 million euros worth of valuation for these two platforms. So can you give some color in terms of what is the price to sales multiple are we assigning, or they are really early stage and we are betting big in terms of the scale up from these two platforms going forward?
So you're absolutely right. There were a pre-money of 60 million, and we're investing primary investment of 20 to get 25%. So pre-money is 60 million. They are based on market benchmarks of ARR-based revenue multiples, because as I said, the contracts with their clients, the established bases are long-term. I don't think we're in a position to give exact numbers, but it is based on ARR revenue multiples for calendar 22 full year and exit ARR rates for this year, which will be in line with the industry. Yeah.
Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Ashwin Mehta from Ambit Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Just wanted to check in terms of financing of this acquisition, will we be largely using our cash or you're looking to raise debt for it?
We're looking to fund this off our balance sheet. There's no plans to raise any debt for the transaction.
So Vivek, if in terms of EPS accretive nature of this transaction, essentially if I assume say a 5% pre-tax yield on your cash, this effectively would mean that you need to generate say 10% PAT margin after in this business for it to be accretive and after taking into account the amortization as well. So is the margins as high for the company?
Yeah, I mean, I think just from what I'm able to share, as I said, the business has industry-leading EBIT margins, and this is post the charges, yeah, on a consolidated basis.
Okay, fair enough. Thanks for the clarification.
Thank you. The next question is from the line of Vibhor Singhal from PhillipCapital. Please go ahead.
Yeah, good evening, sir. Thanks for taking my question. Vivek, just a couple of questions. Is there is no debt on the balance sheet of this company, right? Any sort of debt or liabilities that we are looking at?
No, there is Vibhor, there is no debt or liabilities on this company's balance sheet. You're right.
Great. And the company is free cash flow generating as well, given the high margins that you mentioned that it makes.
That is correct. And that, and that's why in the presentation we said this is accretive across all the financial parameters. Yeah.
Got it. Would you be able to share what was the cash on the balance sheet of the company at the end of the year?
So there isn't a whole lot of surplus cash because the founders have typically dividended out any surplus cash in the business. So it'll be nominal from a closing balance sheet perspective. That's the question, if I can understand the question correctly.
Okay. Right. So, I mean, I was just trying to basically maybe understand, again, maybe this question was asked earlier. It's a company in the digital engineering space, they've been growing at more than 35% CAGR. I mean, you mentioned about maybe the scalability issues that they had. But if it's a free cash flow generating business, they could have basically gone out and expanded their business, hired more sales and marketing team as well. But be that as it may, I mean, the transaction value appears to be quite attractive for a company in this digital engineering space. I mean, it seems to be something like a very scheme deal for us. So I mean, I'm not sure what I'm missing here, but no other constraints that you see in the business that you believe that might have forced them to sell, right? Apart from maybe scaling up from the current level.
No, I think, as I said earlier, we've worked with the founders for close to a year, getting to a point where they believe in the joint value proposition, the vision of this, and I think it's it's getting to understand and build that rapport and understanding was very important, I think, and it's important for the founders. It's important for us from trying to do this together. And no, there are no constraints, and at least at our end, we are very excited that this represents a great opportunity for the company and its stakeholders.
Got it. Thanks a lot, Vivek. Thanks for taking my questions, and wish you all the best.
Thank you.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks for the opportunity. Couple of questions. First about, can you say what will be the client concentration for CTC and how the clients are spread out, if you can give some sense? And second question is about the employee mix. How many of their employee would be insurance domain expert, and how many of them would be largely technology or digital skills kind of thing? If you can provide some mix, because you alluded it is insurance kind of OPD, and in one of the answer you mentioned about horizontal capabilities. So if you can provide some mix, thanks.
Okay, so I think just the second question first, in terms of skill set. So everybody who works on it has, or in the company has deep technology expertise. So that's the first level. And given that they do work largely on the insurance, reinsurance industry, most people will have familiarity with core processes in the industry, and that also on the development side, largely. When we start looking at people who will have a deep and tenured experience of the domain, that number would be about between 30 and 40% of the employee base will have deep and tenured experience on understanding the industry and its nuances and the business processes. To your first question around client concentration, there is, their anchor client does give them about 60% of their revenues. And beyond that, they do have a bunch of other clients which give them the balance spread across the industry.
And how the relationship with anchor client is played out over, because if I look last 3 years, every year we are seeing some moderation in revenue growth trajectory. So if you can provide whether it is largely mirroring anchor client related thing and they have limited success in mining other clients, if you can provide some sense.
I think I did, address part of it earlier. I think from a constraint perspective, the business does not have a large or any sales force of any significance, and I think that's is one of the challenges which, in partnership with TechM, we expect to be able to address better from driving an overall growth.
Okay, thanks.
Thank you. The next question is from the line of Abhishek Shindadkar from InCred Capital. Please go ahead.
Hi, thanks for the opportunity. First, a clarification, and second, a question. Maybe I missed it, but did you quantify the number of clients? That is first. And second is, how should we look at the margin profile of the business? So, you are saying we have negligible sales force. So does that mean that this is a low gross margin business but a high EBIT margin business because, low sales expenses? And related to that is, does existing TechM sales have the capability to sell in? And would that mean that, eventually there could be some margin compression because, we may have to invest in the sales? Thank you for taking my question.
Yeah, thank you. So on the first question, no, I did not, and I think I'm not at a liberty to disclose the exact number of clients of the business. On your second question around margins and investment, we do expect to make some investments in in building a larger sales go-to-market of the business. But the business, at a gross margin and at an EBIT level is all fairly healthy, which is reflective of businesses in this space. And just from a quantification perspective, we all know what is the sales cost in the industry. So we don't think any investments in unlocking growth here would dilute any of the messages we've said around margins and profitability, etc.
Perfect. That's very helpful. Thank you for taking my question.
Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Vivek Agarwal for closing comments.
Thank you, Vedant, and thank you, everybody, for your questions. Just to summarize, and which came out in a number of questions, we at the company are very excited with the growth prospects of this business and its integration and combination within the Tech Mahindra family. And we do believe that this would represent growth opportunities across multiple vectors and will help us take our clients on full large-scale digital transformation journeys, not only in the insurance industry, but across industry sectors with the fungible skill set. And we look forward to executing well on this, driving synergies, driving the integration of the business, and speak to you folks soon on the quarterly results, and would love to update on the progress of this business in the future. Thank you.
Thank you.